Hey guys, Forrest here from Brightworks Financial Planning. I have a follow-up episode today on the senior tax deduction. Now, in the previous video, I just highlighted what is it, how it's calculated, and maybe giving you a comparison of what you would have paid tax-wise under the old bill versus the new passage of the One Big Beautiful Bill Act. This is not meant to be personal, financial, tax, or investment advice. It's just educational. But I want to, in this video, really talk about how you can actually maximize this window for doing Roth conversions. And I want to take a specific angle on this. And the angle is this. Anytime something goes favorable your way, right? It could be a tax deduction, it could be cash back, it could be whatever it is. You have two options. You could pocket it and go on your way, or you could pretend and delay gratification of that benefit and operate under the old rules for a longer term gain. That is the angle I'm going to take in this video, and I'm going to make the argument that we were already under historically low tax rates, so this next 4 years might be a really good time to do larger Roth conversions, subject to the certain phase outs and rules, but it could actually move the needle in a really large way, especially if you want to create a Roth balance that you can then leave on to as part of your legacy. So hope you enjoy this video, and please subscribe and comment. I'd love to hear what you think about it, and I will see you soon. Okay guys, welcome back. I have another video here today, and what I'm going to be discussing is how to quantify and think about maximal Roth conversions under the new rules that are underway as a result of the One Big Beautiful Bill Act. Now, as we start discussing this, I kind of want to set the stage. So if you have not seen my first video on this, please go back and look at it. It's going to give you a lot of good context. Essentially, in that first video, I tried to explain to you what the new deduction actually is, how it's calculated, and maybe give you an apples to apples comparison of how the taxes worked under the previous law as a result of the Tax Cuts and Jobs Act, and how it looks now under the new bill that was passed July 4th. So with that being set as the foundation, now I really want to talk about how you can maximize this 4-year window from 2025 to 2028 to do Roth conversions. Now, one thing I want to start with, and I'm going to pull up my whiteboard here, is basically there is a phase out when it comes to the use of the deduction. So the reason I bring that up is because if you are married filing jointly and your adjusted gross income is above $150,000, you're going to hit a phase out on this credit, or sorry, on this deduction. So the reason that matters is because I'm going to model a conversion that keeps you within that phase out. And I actually want to make a point here. I don't necessarily think that just because you hit the phase out on this deduction, that should never be the primary reason why you do or do not do a Roth conversion. I just want to operate under the assumptions here that we've already kind of looked at the analysis and we decided that a Roth conversion is right for us. So what I want to talk about now is going through some parameters of what I've done and maybe talking you through what it means. And there's going to be another point to this video. So this first one is going to be delay gratification, meaning even if you pay taxes that are anywhere close to what you would have paid otherwise without doing a larger conversion, it's going to be worth it if this meets your overall goals. So I want you to just frame it differently. So anytime you get a tax deduction or cash back, you can pocket the cash, you can go spend it on a nice dinner, you can do whatever you want. But when it comes to financial planning, a lot of times the right decision is the one that is made for the longer term gain. So I am basically looking at this 4-year window and saying you have an opportunity to make outsized gains long term from these short term decisions. So let's talk about kind of what I've put in here, and I'm going to walk it through. The second piece of this video is going to be really the importance of a brokerage account. So if you're watching this and you're not 65 yet, or you're approaching 65 and you have the opportunity to, excuse me, fund a brokerage account, it's just another argument for why you should have a brokerage or a taxable account in retirement, because that's really what's going to drive this strategy. So I'm going to kind of write on the board here my previous assumptions so you can see how they're different. So I'm going to slide down here. And again, this is a couple married filing jointly. On the left, on this column, this is actually showing how things flow through to the tax return. So this is a software I use when we do tax planning for clients. It's good for forward projections, Roth conversions, things like that. So what you're seeing here on the left are the assumptions we put in. So what I'm going to do here is I'm going to kind of point to what we did in the last video so you can see what's different. Okay. So the first arrow I'm going to draw is to the IRA distributions line. So in the previous example, this couple is living off $140,000 roughly. That's what they're actually spending. So what I did here was I did 50,000 from an IRA distribution. Previously, Social Security was unchanged. That's the 60,000 and 51,000 of it is taxable. That's 85% is taxable income. Okay, so I'm not going to go into provisional income and how that's calculated in this video. Please watch the first video. I did talk about that. The next thing here is going to talk through the the capital gains. So in the first video, I assumed that we had a 50% basis in the account, meaning 50% of it is the money they put in to invest and 50% of it is the growth. So what that means is whatever flows through is actually half of what they live on. So in this example, I have 40, but in the previous video, I wrote 15,000, which actually equals 30 of cash flow. So if you pull out 30,000 from a brokerage, only 15,000 of that is going to flow through as a capital gain on your taxes. Okay, so that's kind of why that's there. So far we have 50, we have 15K, and we have 60. Okay, so if you add these together, it's basically 60 plus 50 plus 30 equals 140. Okay, that's the previous assumptions. All right, and that's kind of how I did it. But notice there was a much larger proportion of that. This 50K represents the IRA withdrawal. In this example, I've flipped that completely. So what I want to show you is the more efficient you can be with distribution, the more efficient you can be with Roth conversions. That's really the point here. And so what I've done here is notice on this IRA distribution line, I've put a 0. Okay, so we're not actually living off any distributions. Now, to be clear, this Roth conversion 50 means, all this means for 50, it means that you take $50,000 from your traditional IRA and you just move it over to the Roth. But when it comes to tax time, that 50 is going to show as a distribution. So it is similar to us putting 50 in the distribution line. But I want you to know that we're not living off of it. Okay, that's the difference. So the strategy is we're not living off that money, but the money's got to come from elsewhere. So we have 60,000 from social. Now, at long-term capital gains, we put 40 here. That basically means at a 50% basis, that means 80,000 is actually coming out every year to live off of. And for a lot of retirees that haven't hit RMD age or they don't want to really take out their traditional IRA, this is a more realistic scenario. They're just going to take the money from their larger taxable account. Again, great. This would be representative of a much larger taxable account. Okay. So if this is you and you have a larger taxable account, and again, you have not begun withdrawing from your larger IRA, but you want to think about conversions, this example makes a lot of sense. So you're still living off 140, right? The only difference being there's an additional 50 that's going somewhere else. That's the Roth conversion money. You're not living off that, okay? So our cash flow is the same. I want to be clear on that. So moving on from there, why does that matter so much? So let's come down and let's talk about how this ends up being treated for tax reasons. So our total income is 141. Our adjusted income is 141. And standard deduction is 34,700 plus the 12,000, which is the additional deduction for seniors. So the total deduction for this couple that's 65 is 46,700. Okay. So then we're going to subtract that. Our taxable income becomes 94,300. We're sliding down, keep going down, and we get to a total tax due of 6,039. Now, if you remember, and I may have to do this on the fly, I think this might help you the most. If I put the previous assumptions in, you will see that our tax liability is actually not that much different. But I believe the previous tax liability for the mix I just said, $50,000 from a traditional IRA, 15,000 capital gain, 60,000 for the total Social Security is somewhere around 58. I want to say 58.41. So we're talking less than a $200 tax difference. Now, what's cool is we did a conversion of $50,000. Now, the other thing that makes this so beneficial is that keeps our tax low is utilizing the 0% capital gains bracket. Because you may be wondering, okay, if my total taxable income is so high, how am I paying so low in tax, right? So if we look at that in terms of an effective tax rate, again, we're well below 10. We're at 6.4%. The marginal bracket's 12. Okay, so looking at this, let's break this out. I'm going to show you this, and this may explain it to you. And this is going to further my argument for the importance of the taxable account. So as this pulls up, I want to show you, we can have a total income that looks fairly high, right? So again, we're right just over 140, 141. Our taxable income is 94,300, but we're only paying 6,000 in tax. How can that be? Well, here's the reason why. Is because there's two different brackets that this income is subject to. Okay. So another way to think about this is if we're breaking up these these two taxable amounts, I'm just going to kind of add these for you so you can kind of see this in your mind. On the top, we have our marginal tax bracket, excuse me, which is 30,450. Get something to drink here. So as you're looking at that bracket, that basically represents the federal income tax, okay? So that is subject to ordinary income tax rates, which are on the left. So the lowest bracket is the 10% bracket. So if you have ordinary income up to 23,850, that's going to be subject to that. So realize that this is called progressive taxation. So it's not every amount of income is subject to the exact same rate of tax. It's not. So the first 23,800 is subject to that tax. So that's how we got 2,385. And the next amount is subject to this. Now, there's this whole bucket here where there was 40,000 of that was taxed at zero. Okay. And that's because of and remember, 40,000 is all we took out. So we took full advantage of the 0% capital gains bracket. So taxable income's up to 96.7, which again, their income was 94.3. So we just got in under this, but there was a large chunk of that was taxed at zero, which is why if we add these together, this 54,300. So if we add 54,300 plus 40,000, that's how we get up here the 94.3. And that's how someone who has $94,000, 300 of income can pay very little in tax. Now, to be an extreme example, let's say that they delayed Social Security. Okay, I'll model this for you, even though they're not doing that. But let's just say that they delayed Social Security completely. Okay, so if this is you and you have not pulled any Social Security and you're actually living a little bit more modestly, this would be your scenario. So let's say there's no Social Security. We haven't started drawing. Well, guess what? You probably already figured this out by now. But as long as our total income and our taxable income stays below that threshold and all we're living off of is capital gains, guess what you're going to see down here? Okay, very much next to nothing. Okay, almost zero tax on a $50,000, right? We still kept that. So the only thing I changed here was we're not doing Social Security, but we're still living off 40,000. And the only thing we changed here, again, is just the amount that we're not taking from Social Security. So realize if this is you and you're not actually drawing Social Security yet, I mean, it's hard to beat next to free for a conversion, right? And a effective rate of 0.8%. So what I'm trying to show you here is how you distribute and where you are in terms of what your income sources are really defines this window for you. So again, I tried to start with what I think was more realistic which is most people that are 65 and older, not most, right? Some might not be drawing social. And in that case, you could do that full 50 and pay pretty much nothing. But if you're already drawn, I was trying to just demonstrate that just because you're drawing doesn't mean this window is closed. Okay. So you can still make these conversions and it can still be beneficial for you in a relatively tax efficient way. So hopefully that's making sense to you. And just to prove this, I want to work backwards for a minute. So I want you to hold this number. And so I'm going to write it on the screen, this 6,039 number. Okay. So remember, that's what we pay if we have this income mix and this distribution mix. But I want to go back to how that compares to just how you draw your income. So if you decided to be a little less efficient and you decided, well, you hadn't watched this video or you hadn't thought about this and you were already taking your IRA distribution, let's back the Roth conversion out for now because I want to kind of show you the cost of this, of basically being more efficient. And remember, the previous assumption was a little bit less from long term because we may not have as large of an account. But I want to show you that the income is going to be pretty much the same. I'm going to try and get to 140 in terms of what they're living off of. So remember, it's 60 plus 50 plus 30. Okay, that's how we got to this. And realize our total taxable income is lower, but I wanted you to see cash flow. So cash flow is 140. Taxable income is lower because Social Security is not quite 85% taxable here, but almost. So a little bit less on that. And then what is our actual tax here? And again, we didn't do any conversions. Look. So we're living on the same amount of money. We were just less efficient and we didn't do any conversions, right? So we just missed out on a massive, massive change, right? I think most people would say that that strategy would be well worth it for paying $198 more dollars, right? If I said, yeah, you can convert 50,000 for 4 years and pay 198 more dollars a year, would you do it? Almost everybody would say yes because it makes sense. So in this case, I just want to show you that how you distribute, how you understand how these are taxed makes a huge difference. So we paid, again, not the exact same, right? We still did pay less taxes on the other without converting, but at the same time, here's what you're going to pay for it, right? You just by not having diversification in your accounts and just pulling from your IRA and not doing enough on your taxable distribution, if you try to convert now, right? If we just try and back this out, instead of 50, we're just doing 10 because most of our income is coming from the taxable income side. I want to show you this, that we did a $10,000 conversion and we still paid more than if we would have done 50 under the smarter tax distribution plan. Now, let's show this in another way. And this is how I'm going to kind of wrap up the video, is just hope you see the difference here in terms of how these can be utilized. It definitely makes a big, big difference. So here's what I'm going to show you. So remember, when we look at this, our taxable income is going to be broken out in a certain way. We're starting with what's our total income, our adjusted gross. We're taking away the deductions. It looks here like the math doesn't work, but you have to add in the extra 12,000 to get to 79,300. And here's our total tax number. Well, how's that broken down? Well, look at the ledger now. Look at how much is excluded. Well, it's only 15, right? We only excluded 15 at 0%, meaning there's zero paid on this. But so we only have 15 on the capital gains bracket. So again, how do you bias the brackets? In this case, we're not doing near a good enough job at biasing the brackets, which is making our taxes higher. So what we've done is 64,300 of this is on the marginal income tax side, right? Because we're just taking it from the wrong place. So this just hopefully shows you and demonstrates the power of distribution strategy, what it means for you. And I want to encourage you again, watch that other video, put it together with this video. It really can help you understand that by taking advantage of this window and distributing the right way, you can do some outsized Roth conversions that have some large effects. Now, lastly, I want to leave you with this. Let's say we end up doing that $50,000 conversion. Well, essentially, over 4 years, that's $200,000, right? So, what if we invested that at an 8% return for 20 years? What do you think the return would be? So, just doing this quickly for you. So, if we did an 8% return for 20 years, that is an amazing $996,166. Almost $1 million by being smart through distribution, taking advantage of a window and delaying gratification. You basically almost were able to pass $1 million in a way that's more tax efficient as part of your legacy goals. Again, this assumes that this is something that you want to do and you think makes sense, but just wanted to go through this example for you. Hope it was helpful. Please comment. I'd love to see your thoughts on this and want to know if you want to see more content like this. Please subscribe and follow along as I will continue to make videos like this, and I will see you on the next video. Thanks.